Hi folks, welcome to this special video to read the disclaimer. Today we're going to talk about Ray Dalio's four principles to survive any market conditions. You very well know who Ray Dalio is. He's the founder of Bridgewater Capital. And the idea that he has been promoting is that you should build your portfolio in such a way that it survives any storm. So whether it is booming growth, whether it is high inflation, deep recession, deflation, whatever may come, your portfolio should survive. That is the key uh, underlying thesis for this portfolio. So that you don't need to guess the future. Where should I deploy my capital should not be a guess. It should be well diversified, asset allocated, and then the portfolio takes care of itself. Yes, no portfolio will have zero drawdowns. But as soon as you start having confidence that yes, my portfolio is reasonably protected for any kind of storm that may come my way, you will feel a huge sort of relief in your anxiety and planning for your future. So the all-weather portfolio is designed for that. It's basically no market timing, no bias towards equity or bonds or gold or whichever way. It's just balancing it in a time-bound manner. Whether it is a monthly rebalance, whether it is a 6 monthly rebalance, whether it is a annual rebalance, that will depend upon the design of the strategy. So what is the all-weather portfolio? So he says basically the markets are constantly discounting the future and prices move when reality surprises expectation. So there is a expectation of the market and rising or falling growth and rising and falling inflation. These four situations cause these expectations to continuously move around the prices in the market. So the uncertainty is there, and the fundamental drivers, when we see it from a fundamental point of view, we can set aside our momentum hats for now, is that these four occurrences of growth falling and rising, inflation falling and rising, that will significantly determine where the market expectations will go. So a portfolio that is engineered for all economic environments. So what are the four different environment types? Is that there could be rising growth, rising inflation, or falling growth and falling inflation. Stocks do very well when you have rising growth scenario. Commodities do very well when you have rising inflation scenario. Uh, when growth is faltering, stocks obviously don't do well. Bonds are supposed to do well in that period. And when inflation is coming down, uh, interest rates can be cut, and hence bonds rise as they have an inverse relationship. As interest rates rise, bonds fall. As interest rates fall, bonds go higher. So the four economic quadrant in this four principal situation is you can't predict what will come next. So whether if you are currently in rising growth, then whether you will get falling growth or you will get rising inflation, or of course in rising growth it is difficult to get falling inflation. You get probably rising inflation, but rising growth will have stocks, equities, all kinds of equity derivatives do very well. So strong economy, and it will lift company corporate profits, it will lift corporate activity, investments will go up. If it is a falling growth scenario, then obviously stocks are not doing so well, because now the future looks very bleak for the stocks, especially for the short and mid term. And falling growth is better for bonds uh, as rates start to fall and bonds start to rise. Then rising inflation is a situation where to some extent stocks perform and then stocks don't perform in rising inflation. Um, at that point, gold, commodities that segment does really well, and perhaps real estate also does really well at that time. So hard assets protect value, where rising inflation is basically eating away into the value of the money. So money supply also starts to, you know, go up dramatically. Falling inflation is that scenario where bonds again start to become attractive, interest rate starts to fall, and as inflation is falling, or if it becomes deflation, then fixed income gets favored more than growth stocks. So markets have roughly equal odds of any scenario, so you can balance your bets. Um, uh, if you have rising market expectations, equities, commodities, any kind of corporate credit or credit based instruments, emerging market, this is basically US context. We have our own context here. So in those terms, this model has been working well for the Western economies, wherein they are also able to shuffle between their domestic market and the emerging markets. In Indian context, we really haven't had as many options available to us. But now, as more and more international investing is becoming mainstream, that option is also increasingly available. Uh, Additionally, bonds have had a very uh, nice run for about 40 years, since the 80s till even the mid teens in 2016-17. Bond interest rates have continuously been falling. And now, to for interest rates to fall further looks difficult, because structurally things are changing, and that 30-40 year trend is changing. So that would mean that it will be very difficult to get interest rates down, as inflation also is rearing its head. And that is why the traditional 60-40 bond portfolio that the West has always recommended is beginning to falter. 60% into stocks, 40% into bonds. 60% part has done really well, but the 40% part in bonds in the last decade has given almost zero returns, because interest rates a decade back were where we are approximately right now, and that has really not done very well for that portfolio. So while 25% risk in each quadrant is nicely uh, proposed here, I think in Indian context, equities, real estate, gold, and some into bonds, and some perhaps liquidity is all that is needed. If you really want to diversify, then perhaps some part of the equity can be international equity also. So the Western portfolio, of course, was back tested through great uh, depression, Weimar Republic hyperinflation, and almost all crises, and it worked very well. In that, you can see here that in this chart, uh, the all-weather portfolio is this purple line, 60-40 is this yellow line, and the S&P 500 is this blue line. So while obviously the S&P 500 has beaten that portfolio dramatically, but the whole idea here is that the smoothness of the curve that you will see in the purple line is basically the low volatility of this curve. So essentially, if you want low volatility and to be consistently performing in every kind of a scenario, then the all weather portfolio can also work well. In Indian context, you can see here, for instance, in the last 10 years, the blue line is that of Nifty, the yellow line is that of gold, and the green line is a sort of a equivalent all-weather portfolio, uh, which has a very smooth curve, this green line going through. So while the returns are slightly up and down between the three, but the smoothness of the curve of the 50-50 portfolio is just simply mind-boggling. So that's what is intended that a all-weather portfolio be achieving. Perhaps not the highest returns, but the best smoothness of equity curve as you go along. So we have available a lot of ETFs in India. If you want to adapt to such kind of a portfolios, we have 30-year G-Secs, 10-year G-Secs also available. Gold ETFs are available. Index ETFs are available. So all those can be put together to make a viable all-weather portfolio. Uh, Many such all-weather portfolios have performed very near to Nifty returns in the last decade and two. And this rebalancing of the assets within that portfolio is the key, basically, wherein you are constantly, when you are rebalancing every year, then the segment which has done well, you're basically taking some money off that segment and putting into the other segment and making them equally again. So that logic really works very well in terms of uh, taking away some of the profits from the assets that have really done well. So four timeless principles are: balance beats bias. So 25% risk we can uh, take in each quadrant. Don't and remove all the guesswork. Diversification is free alpha, so reduce risk without sacrificing returns. Universal and timeless, so it will work in any era, whether depression is coming, whether inflation is coming, whether war is there, and so on and so forth. And the cash, according to Dalio, is the worst long-term assets, and cash portfolio will get beaten consistently, and especially now when the money supply in the world is in double digits continuously. And so every year, regardless of whatever calculations we may say, we are going down by that much amount in terms of value of our cash. So the idea should be to remain invested and not have idle cash. And the final quote from Dalio is that notion of balance is going to be better than not balanced. Diversification doesn't cost you anything. So let me know your thoughts on diversification and asset allocation. Are you applying similar kind of principles in your approach towards the market? If you wish to take a look at some gold backed momentum model portfolios, there's a link in the description. You can go watch those. You can watch these videos. And if you like our content, do give us a like and a share and subscribe to our channel. Thanks. Bye.